Good morning and welcome to this Wednesday, July 21st, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we've got earnings coming in fast and furious. Things will be picking up even more over the next few weeks. But clearly, companies are being rewarded for really strong reports, others not so much. We've had huge pandemic, obviously, supply shortage, demand picking up. So there's expectations for companies to do really well. And surprisingly today, between yesterday after the close and this morning, there have been a number of companies that did not meet expectations, especially on the bottom line. So that's going to be interesting to see how the market treats companies like that. I know a couple of them I saw were getting hit a little bit in pre-market, but we'll see whether or not they bounce back and whether the market looks more ahead at the future or whether they look at some of these companies that missed and, maybe we get that negative reaction. I don't know. We'll see how the market reacts to it all, but it's going to be an interesting day for sure. We're going to get into all those earnings reports in just a minute. Let's see. First, before we get into anything, for those of you that are new, let me go ahead and bring you over to Earnings Beats, to our website. If you go to earningsbeats.com, you can simply scroll down to this left corner here and type in your name, email address, hit the subscribe button. It's our free Earnings Beats Digest newsletter. I publish it Mondays, Wednesdays, and Friday mornings. It's educational. We're looking at relative strength. We're looking at earnings, the things that matter to us. I think it would be very educational. I think it will add something to your trading style or investment style. So check that out. Go to earningsbeats.com. And again, just click on the lower left-hand corner, and you'll see the name, email areas where you can enter those and sign up. It's completely free, no credit card required. You can unsubscribe at any time. We'd love to have you. All right, taking a look at what happened on Tuesday. Dow Jones Industrial Average, a big rebound. So we had the huge drop on Monday. Of course, it was the Monday after options expire. Not shocking to see that kind of a move to the downside, given that it's this week of July, between the 17th and the 24th. This is one of the 3 worst weeks of the year historically. One of the others, by the way, is in October, also lines up right as earnings season kicks in. I believe that's the 21st to the 27th of October. So 2 of the 3 worst weeks line up with essentially the start of earnings season. And so it kind of plays into that theme. A lot of folks who just casually watch the market don't understand how it works, but Wall Street buys shares ahead of earnings, that we get those pre-earnings advances. And then when earnings start coming out, even some good earnings, we see sell-offs, buy on rumor, sell on news. Anyhow, got a big bounce yesterday, got back some of those losses on the Dow. S&P 500, same thing, filling the gap from that Monday gap down, finished up 64 points, 1.5%. NASDAQ actually got through the gap. So we not only filled the gap, but we finished above it, rose 1.57%, 223 points. If you look at the percentages here, all pretty close, 1.62, 1.52, 1.57. So it was really across the board, move back to the upside. Mid caps and small caps did even better, gaining close to 3%. Mid caps 2 3/4, small caps just under that 3% level, both bouncing off of pretty important levels. You can see the mid caps on Monday took out lows from the last couple of months, bounced right back, filled the gap, and now have a test at the 20-day moving average. We'll see if we can get through. Small caps still have a little bit of room up to that 20-day moving average, but they too had a really nice bounce. And as I look across the major indices, with the Dow breaking below the moving averages, when I see crosses of moving averages, I think one of 2 things. I think either a shift in trend, or I start thinking, okay, we're in a trendless environment. We're in a sideways consolidation environment, because when you start going sideways, trendless, these moving averages really don't mean as much. So you'll see breakdowns, then you go right back up above. And if you notice what the Dow's been doing really for the last couple of months, we break below the moving average, we break above, we break below, we break above, we break below, we break above. Now we're breaking back down below. Yesterday, we're trying to get back up above. We remain in sideways consolidation on the Dow. It's not that clear on the S&P and the NASDAQ because both had broken out. But still, you have an uptrend in play. Trend line I'd watch there on the S&P. NASDAQ, I think just maybe that recent low around 14,000, the 50-day moving average, keep an eye there. As far as the sectors go on Tuesday, industrials and financials, we saw a bounce back, a big reversal in the 10-year Treasury yield. And that had a lot of folks jumping back into industrials and financials in the near term. We are going to see how we react to these moving averages again. 20 and 50-day moving average, we're right there on the XLI. XLF, we're just a little bit below. But look at these little kick saves. Both of these ETFs took out the low from June on an intraday basis on Monday, but came back up and closed above it. So that was a good little kick save, and then we rebounded off of both of those. So that was pretty good technical action, but we do need to watch that level now that we've seen multiple tests. A breakdown below would be a little bit more meaningful. The consumer discretionary group, big breakout in July, and we've pulled back, went all the way back down to the 50-day. Nice little hammer. We bounced off of that. I'm going to be watching discretionary and technology. I think these two in a secular bull market advance, we want these two to be leading the market. They started to the pullback on the discretionary stocks last week or so. I think some of that could have been options related from last week after a huge move up in the group. But I'd like to see another breakout in the XLY, XLK. I think that would help confirm that we remain firmly in this secular bull market. Real estate continues to trend above its 20-day. It'd be hard to argue much against the real estate being one of the better groups here over the past few months. I don't know that that will continue, but lower interest rates certainly wouldn't hurt. Technology bouncing off the 20-day moving average. So far, so good there. All right, economic reports out this morning. Nothing of any significance. So the market's going to be left to trade more on earnings, which it usually does anyway. 10-year Treasury yield. Let me get an update here, make sure we got the latest. Currently, it's up about 4.5 basis points, 1.255. So trying to get back up, fill this gap. We still got the 20-day EMA, which is declining. Got to try to get back through that. But on this little reversal and bounce, you can see XLF relative to the S&P trying to bounce, and the XLI back up at its high probably for the last 2 to 3 weeks versus the S&P 500, just on that little bit of a bounce. So good news there for those two areas as long as we see the 10-year Treasury yield moving higher. One last point, I try to bring this up from time to time, so you've probably heard me talk about it quite often. But anytime you've got a period where the 10-year Treasury yield's going down, we should be expecting more choppiness in the S&P 500. That's typically what happens. We can see a period of rising prices on the S&P, and that's what we've seen over the past couple months. But if we stay down here in the 10-year Treasury yield and don't rebound, I would expect that things are going to be choppy ahead. And that's generally what we see in the summer months anyway. So we'll see some ups, we'll see some downs. I think the secular bull market remains in play, but don't be shocked if we do see some, selling followed by rebounds, followed by more selling as we go through this period of consolidation. All right, next up, I wanted to go through and talk a little bit about the consumer discretionary groups. So I'm going to spend some time here going through and looking at the industry groups that make up the XLY. So the first thing I wanted to do is look at recreational services. This has been a very, very weak part of the group. You can see multiple tests up here at about 118. Support was right around 98. Well, we went up through 118 and had a false breakout, and then turned around and came tumbling back down, lost support. And now I'm looking all the way back down here at this support level, which I think is pretty important because off of this move, setting new highs, this was our reaction low before we set new highs again. So that's a low that I think is really important on the chart from a more intermediate term perspective. So watch 83, 82, 83 on this recreational services index. The furnishings group, a little bit better group for sure. Whoops, took out one too many letters there. I like the rebound yesterday off of the support area. I think it's pretty clear that we were in an uptrend at the highs. We had a negative divergence. We sold off. went a little bit below the moving averages, but I think simply to establish a low, bounced, now came back down. This is a double bottom. If we can get back through 500, that would be very bullish on the furnishings index. Otherwise, let's watch this double bottom breakdown. Would not be so bullish, probably would lead to where we broke out all the way back here, closer to about 385, 390. So it could be pretty steep drop. There are other areas. I would say this support level around 440 would be one, this long tail down here. But the big one that we never tested was the breakout back in February. So let's just keep an eye on that double bottom there. I think it holds, but doesn't matter what I think. If it breaks down, we want to be careful. Clothing and accessories continuing to trade sideways off of the uptrend. So I think these recent lows down here closer to 380, you can see we tested that on Monday before rebounding. I think we're just in sideways consolidation mode here. Tires index. This one looks to me like it's kind of rolled over and is definitely trending down, failing to get through that 20-day moving average. So as long as it continues to trend down beneath its 20-day moving average, I'd probably steer clear. If you're looking for a spot for a reversal, I think this breakout right in here, I think anywhere around 520, 525 would be an area. If we continue to trend lower, that's where I would think the bulls may start to come back in on tires. All right, auto parts. Auto parts, we've had multiple lows anywhere from 580 up to about 600, 605. So this whole area right in here has been pretty good support. We went down, almost got to that 580 level. Looks like maybe 582, 583. Big bounce yesterday. Of course, that's what the overall market's been doing. But we've got that 20-day EMA to try to get through here. And that's where we've been struggling the last couple of times we've rebounded. So let's watch that level closely. All right, next up is the hotels area. And here you can see the breakout above this triple top right at about 2240, 2250. Big move up and sideways consolidating ever since. Can't get through 2600. Went back down to about that 2240 level. That's where I would watch for key support to hold. All right, gambling stocks. So gambling stocks broke down below the May low, trying to hang on to the low that we saw all the way back in January. I think that's a pretty big low because we did break out from that area. So right at about 750, went back down almost to 750 here, touched 750 on Monday. A couple of nice candles there trying to react back to the upside. Watch again that 20-day EMA here. All right, recreational products. I'm still a fan of this group, although we do now have a double bottom in play at 620, so we'll want to watch that level. To the upside, a break above 670 would be bullish, likely taking us all the way back up. This could be a cup off of the uptrend, but I'd say 620, any close below 620 would negate that pattern. Autos, we've definitely got a big double bottom that's set all the way down at 750. And we had a huge run up in automobiles prior to the pullback to the 750 level. So the group needs consolidation, needs a period of kind of, a base being formed. And so I'm okay with the group as long as we stay above 750. Almost, if you go back to these lows and you connect the lows coming up and then you connect these highs, almost like a symmetrical triangle that's squeezing into a pretty narrow area. So I think if we get a breakout above 910, 920, that would be a really bullish development for autos. Travel and tourism. So we did have a pretty good day in this area yesterday, gaining 2.5%. Got the gap up, the reaction low down at about 720. You can also see January, the low around 740, 775 here. We're kind of in this range. I would have liked to have seen this level hold. We did go down a little bit further. So I'd keep an eye on this January low at about 740 or so, break below that level. And I think travel and transportation being a little bit more trouble technically. Home construction continues to trend lower, but we have the double bottom. We have this double top. So for now, it is in this trading range, 1400 to the downside, 1525 to the upside. Specialized consumer services, one of the better looking charts in this area. You can see the volume picking up. Also notice that we're holding a rising 20-day. Many of these other groups we've looked at, we're talking about trying to get back through the 20-day or sideways consolidation. This is actually trending higher. Beautiful move up, breaking above the 50. And once I start seeing successful tests on the 20-day, PPO above the center line and rising, I start thinking bullishness. So we do have to get through 2340, 2350. That's the next step. Got another 1% or so to get there. But this is a really strong looking group to me. RU, that's the restaurants and bars, another group that's been trending higher, breaking out above the prior highs, went back, held the 50-day. I think if we started back in here, we probably have a nice little trend line going. I would expect a breakout in this group. I think we're going to head back up, clear that 2510, 2515 area, and that should help. By the way, Chipotle reported earnings. That's not going to hurt this group. A big reaction there. Let's see, next up, we have Next Toys. So TY, whoops. Sure what the heck just happened there, but okay. TY going sideways here. We got highs right at about 1435, 1440 to watch. The recent lows just under 1300, very similar to a lot of other charts that struggled since that February high. Many of the consumer discretionary technology areas, growth areas did struggle starting in February. And that's why we're seeing so many of these consolidate. But if we start to see breakouts, that would be very bullish, not only for this sector, but also for the market. All right, just another handful of these, then we'll move on to earnings. Next up, durable household products. Again, I think we've established pretty key resistance up at about 370, support closer to 320. We're in the middle of that range right now. I'm okay with the group, but I would expect more sideways consolidation. How about home improvement retailers? Very similar to what we just looked at. High established just above 740, low established just below 660. We're in the middle, trying to hold on to the rising 20-day that's just crossed over the 50. So another breakout here through about 705, 710, I think would be bullish short term for the home improvement group. Footwear, we've had some pretty good reports in footwear of late, especially Nike. That's the Nike report right there, and the jump to a new high. We continued moving higher. I think we're just consolidating off of this. We got Crocs coming up, Skechers also going to be reporting. So that's likely to determine the short-term direction of the index. But I do like the group. I think that breakout was significant. All right, three more. First, specialty retail. Put in a double top here, 2750. The lows continue to get higher, which is good news. Trying to hold on to this rising 20-day. If we can break out, that would be excellent news for the specialty retail group in the short term. The business training. Business training and employment agencies. This double top right here, 185. You can see we just came down, tested it, went a little bit below last 2 days, but we've held on. I'd like to see this now break back up through the 20-day. That likely would just suggest more sideways consolidation, but breaking above the 20-day would be better than the alternative of breaking down back below 185. So this is an area I'd like to see some strength coming in here. Broadline Retail is the last group in the space. One of my favorites, not just in consumer discretionary, but overall. I love this breakout after a lengthy period of consolidation. We've come back down. We've tested the 20-day, put in a nice hammer. Yesterday, we were down intraday, came back, rallied above the 20-day EMA. I do like this group. I'd be maybe a little bit more careful if it lost 35.50, and especially if it were to come down here and lose about 34.50. But otherwise, I think this is a group worth considering on this pullback. All right, let's go and take a look at, I could have sworn, I don't know what I did here. Let me see if I can get that back up. There we go. All right, so let's take a look at some earnings reports, and got a bunch of these to go through. But the first one is Netflix. And what I will also do is let's get away from some of these other things we don't need. All right, I'm going to take a look in the pre-market and just see what some of these stocks are doing here. So Netflix first, down $5, 526. They did come up short on expectations. And this is what I was talking about. You know, so far in earnings season, we've seen almost every company beat. And heading in, I expected most companies to beat. Netflix was expected to earn $3.16. They came in at $2.97. And so you can see down $5. Recent highs, got to get through about 560 to really see more bullishness. 526, we're back down below the 20-day. I just see more sideways consolidation. Earnings was not the catalyst for Netflix at this point, unless we see a bigger reaction later today. I think it's just going to be more of the same, more sideways consolidation. Next company, ISRG. This is one I really liked going into earnings. The stock did report better than expected, $3.92 versus $3.16, up 3%. Pre-market's going to break out to another new high. And, you know, outside of maybe a sell on the news, you know, once we get that gap up, market makers will be on the short side. So maybe we come back and fill. But I do like ISRG. I think in time it goes higher. This is a nice looking chart, and the fundamentals are strong as well. Next up, moving to the railroads, Canadian National Rail, CNI. They beat barely, $1.21 versus $1.20. The stock pretty flat, but you can see railroads, transportation stocks in general have been very weak over the last few months. And I've said this recently, the two things that worry me about the market, there's always something that you can point to that's just not what you would expect. The two things for me that have been surprising, the lack of participation by transportation stocks, and not lack of participation, but outright selling. And then also the movement back toward bonds with the 10-year Treasury yield. Those are the two things. If there are two things that keep me up at night about the market, those are the two things. I don't like seeing all this money going into bonds, and I don't like seeing transports not participating. But there are a lot of positives. So I wouldn't, you know, when you put the whole jigsaw puzzle together, I believe we're going to see the yield rebound. I believe we'll see transports rebound. I think there's too many other bullish signals to be bearish on just those two, but definitely those two are problematic. Chipotle. So Chipotle came out. They blew away estimates, $7.46 versus $6.46. Beat it by a full dollar, and you can see the stock up 5%, another $78. It has been on a tear over the past month. Pulled back a little bit prior to earnings, but now breaking out again with this action. One stock in last night's Q2 earnings webinar I did not like heading into earnings was IBKR. And IBKR missed. They came in 82 cents versus 83 cents. It's flat, not really selling any, but you can see what Wall Street was telling us coming in, not to expect a whole lot out of IBKR. And we didn't get a whole lot, missing estimates. Next up, XM, Qualtrics International. This is a company that was expected to lose 2 cents. They actually beat and had a profit of 4 cents. So a nice little beat there. Stock up 2.5%. It's been downtrending. This stock was public back in February or late January. So it hasn't really had a big history. I think it's trying to figure out where it belongs, but it does have a little triangle in play. So move back up above this double top closer to, if we get closer to $40, that would start to bode well and look a little bit more bullish on this chart. Next up, AGR. Avangrid, not seeing any action here. They did miss, though, 35 cents versus 42 cents. So we'll see what kind of reaction we get when the market opens. Sleep Number was a big miss. SNBR, stock down 14% today. Look at what it's been doing. Once again, Wall Street telling us not a good stock going into earnings. They were expected to come in at $1.11. They came in at 88 cents. All right, let's go through just a couple of the big earnings that came out this morning. Those were all yesterday's, by the way. J&J, this is one that I like. It can't see it here, but this is an ascending triangle. equal highs, rising lows. The stock came out with earnings that beat 248 versus 228 and up a little less than 1%. It's got to get through about 172. And if it does, I think Johnson & Johnson would be a great play. Even a pullback, anything back around 167 to the downside or a breakout above 171, 172. That's what I'd be looking for there. ASML, big semiconductor stock. This is one I liked going into earnings. 304 versus 289 in a nice uptrend, up $21 with earnings. That's going to take it up to 705, not breaking out, however. So if you see the stock make a run for 720 and it can't get through and earnings are out, I would look then for more sideways consolidation. Coca-Cola, 68 cents versus 57 cents. So a nice beat here, up 2.5%, above the recent high. So breaking out here as we prepare for the opening bell. Let's see a couple of others. SAP had a nice report, but not a nice reaction. Well, when I say nice report, I only saw their earnings, 211 versus $1.49. And even though it's trending higher, it's been underperforming software by quite a bit. And so this is one I did not like going in. Stock is down 5% with its earnings report. Let's just do a couple more of these. I wanted to see Mktx because that's one I didn't like going in. You can see it's been moving lower. This is in the investment services area. It's been going down. The stock, even though they did beat 177 versus 168, stock's down 11 cents pre-market. For some reason, Wall Street's not a fan. And as a result, I'm not a fan. IPG, this is one that I did like going into its earnings report, and it is up 4%. Came all the way back, tested this breakout level, but this is one of the stocks. I'm going to pull this one up. Let's go over here. I'm going to pull this up on a relative chart because the thing I liked about IPG, first of all, it's been going up sideways consolidation. AD line looks good, but look at the stock relative to the media area. See how when it set its high over here, it was at a 52-week relative high to its peers. So it's been pulling back, but it's been pulling back while it's been consolidating. So this is one I gave a pretty good shot coming out with a good report. We are seeing that IPG looks pretty good. Last one I'm going to pull up is HOG. This is one of our portfolio stocks. We are getting a decent reaction. It's up 1%. Went all the way back, filled this gap. I'd like to see the stock get back through the 20-day, begin trending back to the upside. So pretty good action, at least pre-market action there on HOG. They beat, by the way, $1.33 versus $1.15. IPG, the one I was just showing you, they beat 70 cents versus 45 cents. So pretty handy beat there. All right, let's move on to the three you must see, and let's wrap this thing up. I'm going to start with Manpower, MAN. Let's look at it on a relative chart here. So we had just been going sideways, struggling to get through about 125 on multiple occasions, and then came down, took out this double bottom on volume. So it looks to me like we're probably going to head back to test this breakout level about around 103, possibly even the most recent low down 95. But it's now starting to act like a downtrending stock here. So until it gets back through that 20-day moving average, I would be careful. Next up, Unilever, UL. This is one that's struggled for a long time trying to get through $62. The fact that it's gone the last year without moving back through that October and November double top, I don't even need to look at the relative strength. It's not good. And when we do pull it up, you can see near 52-week lows versus both its peers and the S&P 500, while the group is at a 52-week high. So this is a stock I'd be careful with. I think we may see another breakdown below these recent lows. And then finally, PPG. We had an island cluster reversal. See how we got the gap up off of an uptrend. Gap up, long period, long cluster right here, and then gap down yesterday. We did rebound off of it. Need to hold this gap support. If gap support fails, especially with this island cluster reversal, I would be looking for more downside action, potentially all the way down to 133. All right, that's it for me. I appreciate everybody tuning in today. I'll be back tomorrow over at Stock Charts TV for the next recorded version of Trading Places Live. Hope to see you over there. Have a great day, everybody. Enjoy the rest of the week. And the next live Trading Places live show will be next Monday right here at earningsbeats.com. Have a great day, everybody. Happy trading.